Hi, this is Alberto Pau from myforextradingsuccess.com, speaking from London, UK. Cold winter night over here. By the way, I'm heading to Sydney, Australia tomorrow, so hopefully the weather is going to be a bit more welcoming down under. But anyhow, today I'd like to speak about a very simple momentum trading strategy that is so simple that you can actually just start implementing today. The strategy revolves around 7 principles or 7 checkboxes. If you can tick all the 7 boxes, then your probability of making a profit by putting on that trade is going to be very, very high. And that's why I call it a momentum trading strategy, because as you will see, all those 7 principles are around making a profit out of the momentum that is in the market. But let's get going. The first 2 principles are: number 1, trade with the trend. As I said, this is a strategy that will seek to profit from the momentum in the market. So don't try and short an uptrend, and don't try and go long in a bearish trend, obviously. Simple, I know, and it may sound obvious, but way too often I see traders that get very badly burned by going against the market or the trend. Principle number 2 is you need to make sure that when you consider putting on the trade, the moving averages are fanning. And what does this mean? It means that the long, medium, and short-term moving averages must be diverging. So if we look at this example here, and let me get my highlighter, you see that we have the 62 smoother moving average, which is the 62-day moving average. Then we have the 30-day moving average, and then we have finally the 5-day moving average. Well, the fact that here the 3 moving averages are fanning, which is they're getting further and further apart, is a good sign. It means that the price action is increasing in momentum, because not just the 3 averages are all going up, but the short-term moving average is going up faster than the medium and the long-term one, which means that the price is gaining momentum. Principle number 3 is that the price must be near 2 buy or sell zones in 2 different time frames. This means that, say, you think you want to go long because the price is close to a support level. Well, you need to make sure that the price is testing successfully a support level in 2 different time frames. So for example, a 5-minute time chart and a hourly time chart. All you need to do really is just plot the price in 2 different charts in 2 different time periods, and make sure that in both cases you're getting a buy or a sell signal from that chart. In this specific example here, if I want to go long because I think that this is actually a good test of the support level, I will need to make sure that this relationship holds on 2 different time frames. Principle number 4 is, before you put on the trade, you need to have a small candle in the direction of entry. What do I mean? Well, if I think that's an uptrend and I want to go long, before I put on the trade, I want to wait and see a small bullish candle. In this specific case, it's here. Let me highlight it for you. Here. Okay, now what's been happening here is that the price has been coming off and it's been testing the support level, and let's just say that principle 3 holds. So we've tested this support level in 2 different time charts. Now I want to wait to have a small bullish candle as a confirmation that the trend is reversing. And in this case, I have it here. Principle number 5. And this is going to be the trigger for me putting on the trade. Okay? I want to enter the trade as the next candle breaks the previous high or previous low. Okay, so as you may remember, here we had the test of the support, and here we had the small bullish candle, and here I can notice that the next candle is actually making new highs. Okay, let me just delete what I've done here. Okay, and I can indeed notice that here this is a new high, and therefore that's a further confirmation that the trend is reversing. Okay, so just to recap, test of the support level in 2 different time frames here, then small bullish candle here, and then new high here. Principle number 6 is to do with once I enter the trade, where do I set the stop loss? Well, I want to set the stop loss at the opposite of the small candle. Okay, so in this specific case, I want to set the stop loss at this level. Okay, I've gone long here. Let me just try and change the color so it's clearer for you. Okay, so I've gone long here, and apologies if this is very small. And I'm going to set the stop loss here. I can't increase the size on this, it's a real shame. Okay, so what I've done here is I've taken a bigger size chart to illustrate the point. So we were having a look at how I could set a good stop loss level. We've agreed that I'm going to set a stop loss level here, okay, which is the bottom. Okay, what I have here is a zoomed in version of the chart we had on the previous slide. We were analyzing how principle number 6 is to do with setting the appropriate stop loss level. And we want to set the stop loss level at the opposite of the small candle. So in this particular case, I want to set my stop loss level here. Okay, so just to recap, I've got in at this level, which is going to be which was the new high in the price, and my stop loss is here, is the purple line. My entry level is the red line. Now, this is a follow-up on principle number 6, which is you don't want to risk more than 1% of your capital at any point in time. So we've said where to set your stop loss in relation to your entry level, and we've also said that you don't want to risk any more than 1% of your capital. So that means that you need to solve for the notional amount such that your maximum loss is no more than 1% of your equity. In terms of the specific level, you want to set the stop loss and then obviously put the order with the broker at 1 pip plus half the bid offer spread away. What do I mean? If you get a stop loss level of say 120 on euro dollar, okay, and the bid offer spread is say 2 pips, okay, I want to set the order with the broker at effectively 1.1998, okay, which is 1 pip away plus half the bid offer spread. So the bid offer spread is 2 pips. So I want to set the order with the broker 2 pips away from 120. That's essentially to make sure that the price has really broken through the stop loss level and it isn't just a broker playing games. The last principle, principle number 7, is about setting the profit target. Or I should say the profit targets. You want to set your first profit target at a ratio of 1-to-1 reward to risk, which means that if you are risking 20 pips on your stop loss, you want to set your target profit 20 pips in the money. Okay, so you're risking 20 pips and you're making 20 pips. You only want to do this for a third of your notional. The second third, you want to set it at a ratio of 2-to-1 reward to risk. So if you're risking 20 pips, your target profit is going to be 40 pips away. And finally, you want to let the third target profit run until you get stopped out. Okay, so if you get the trend right, obviously as the market moves in your favor, you want to be adjusting your stop loss accordingly. Okay, and eventually you will see that even if you get stopped out, you're still at a profit because the market went so much in your favor that you have been adjusting your stop loss. So your third of the notional, you want to let it run. A frequently asked question I get is, why do you not invest more than 1% in each trade? Some people go as far as investing 2-3% of their notional. Remember, no matter how experienced you are, handling losses is psychologically difficult. Okay? If you trade a small amount and take the profits off the table frequently, it not only increases your confidence, but it keeps your equity account curve in a smooth, nice, slow uptrend. And also remember, as your account size grows, your 1% of your account size will become a bigger and bigger absolute dollar number. Just a couple of quick points on mastering your trading psychology, given that we mentioned that handling losses is difficult. When you trade, set your trades in the system, orders, stop losses, target profits, etc., and then close the charts and do something else. Go away. The more you look at a chart or at a trade, the more you will start tinkering with it, and you'll end up losing the focus on what's happening in the big picture. So, make sure you tick all the 7 boxes, but follow the 7 principles, make sure you tick all the 7 boxes. If you do, set your trades in a system and then go away. Go do something else. A couple of other points on trading psychology. Set up daily routines. Very few people can trade on the fly. And you'll see that if you start using a routine and it makes you money, as soon as you change your routine, your profitability will change. That's a proof that there is a direct link between your trader routine and your profitability. And the goal is to find a routine that makes you money. There's a lot of brokers nowadays that offer the ability to trade on iPhone or other smartphones. Don't use it. Okay, as I said, very few traders can be completely focused and trade on the fly. It's just a means for brokers to kind of get you away from the competition, which is like offering you the latest technological gadget. But if you can, stay away from those devices. This is all from me, Alberto, today. If you want to learn more about foreign exchange and how you can fast track your way to profiting from forex trading, make sure you join my newsletter where I regularly give video trainings, webinars, articles, and so on and so forth. If you're not there already, go to vip.myforextradingsuccess.com and make sure you sign up today. That's vip.myforextradingsuccess.com. I'll see you on the other side. Bye bye.